So one way a company can raise money is to issue stock. Stock represents percentage ownership in a company. This is why stocks are different from bonds. Bonds are essentially loans with a fixed rate of income, whereas the value of a stock changes based on the value of the firm. So since stockholders are the owners of the firm and they elect directors who then hire management, management's fiduciary duty is to the stockholders. This translates into management's goal, which is to maximize the stock price. So we know the value of a firm is equal to the present value of all the future cash flows it plans on generating. Since each share of stock represents a small percentage of the firm, the value of the share is simply equal to that percentage of the value of the entire firm. We call the current value of a single share of stock its current price, which we denote P sub 0. Again, a single share represents a sliver of the future earnings potential of the firm. So, if an investor were to pay the current price for a share of stock, what would they get in return? Well, there are two ways a stockholder can make money. One is through capital gains. These occur when an investor can sell his share of stock at a higher price than what he paid for it. The second way is through dividends, which we denote D sub 0. That's the dividend in time period 0, today. These are periodic cash payments made by the firm to all stockholders. So everybody who owns a share of stock, maybe the firm decides to pay a dividend of $1 to each shareholder. So if you own more than one stock, say you own 10 pieces of stock, well, each one of those pieces of stock would get that dividend of $1, so you would receive a total of $10. Like any other security, the value or price, what we call price of a stock, equals the present value of all of its future cash flows. So it's the present value of any future dividend payments. The discount rate used is called the return on equity, denoted R sub S. And this is just to distinguish it from maybe the return on debt or some other interest rate that we might be using to discount future cash flows. For example, suppose a stock pays a dividend every year, starting next year, for $2. If the discount rate is 10%, what is the current price, P sub 0, of the stock? Well, since the dividend payments are made once a year and they don't ever stop, we can just treat them as a perpetuity. So the price is simply the present value of a perpetuity whose cash flows are $2 every year with a 10% annual discount rate. And here's the equation for the present value of a perpetuity with the cash flow in period 1 on top divided by this return on equity, this rate that we're going to use to discount back our cash flows to find the price of the stock. And again, the most important part about this equation is that the dividend occurs in period 1 and the price occurs in period 0. Now, it's not necessarily important that the dividend actually occurs 1 year from now and you find the price today. All that matters is that the dividend occurs 1 year after the time period in which you'll find the value of the stock. So you could use the dividend in period 5. And if you use that and you divided it by the rate of equity, the return on equity, this discount rate, we would find the price in period 4. So you find the price 1 period before the first dividend payment occurs when you use this formula. So in our case, the $2 starts next year, so that's the dividend in period 1. We divide it by the 10% discount rate, and so we find that the price today in period 0 is $20. Sometimes the dividend of a stock will grow over time. In this case, we treat the price of the stock like a constant growth annuity. The formula becomes the price in period 0 equals the dividend in period 1 divided by the return on equity minus the growth rate. We've seen this formula before. We're just applying it in the context of stock valuation. And G is the rate of growth of the dividend. So now we're saying we're going to get a dividend, but this dividend, maybe instead of being $1 every year forever, is going to grow. So maybe it'll grow by 10% every year. And this is how we take into account that rate of growth. So notice that if the growth rate is greater than the return on equity, the discount rate we're using, the price would be negative. So to use this model, we must always assume that the return on equity is greater than growth. That's just a plain assumption that we're going to have to make. So let's look at an example. Suppose the dividend of $2 in the previous example begins 1 year from now, but after that it grows at a constant rate of 2%. What is the price of the stock? Well, we can just use this formula. The dividend in period 1 is $2, the return on equity is 10%, and the growth rate is 2%. So in the denominator, we have 0.10 minus 0.02, and that's going to give us a price today of $25. So one way to find the growth rate is to use the following formula. So it could be given, as it was in the last example, we were just told the growth rate was 2%, but also we can use this formula to find the growth rate. It's the growth rate equals B times R, where B is the retention rate and R is the return on equity. This return on equity is different than the required rate of return on equity that we were using for a discount value. This is actually a statistical measure that talks about some of the performance measures of the company. So let's define it. First, let's define the retention rate. It's the percentage of earnings that the firm intends to keep within the company and use for growth, as opposed to distributing it out to investors. And then the return on equity is the after-tax net income earned on all shareholder equity. So the retention rate at the end of each year after a firm has earned its money and paid off all of its operating costs, it has some money left over. And some of it will pay out to the owners. Maybe the owners will take a withdrawal, or it will pay to debt holders or equity holders. But there's some that it will decide to keep inside the firm and reinvest and use to grow the company. And that's exactly what this retention rate is. And the return on equity, again, is how much the shareholders are earning on their investment. So it's just the net income, after-tax net income, on all the amount that all the equity holders have invested. And so we would have to be given these two numbers to use them to find the growth rate. So for example, if we were told the retention rate was 40% and the return on equity was 5%, a reasonable estimate for the long-run growth rate, well, we would use this formula. Growth is equal to the 40% retention rate times the 5% return on equity, and we could say that the growth rate would be 2%. Now let's look at some measures that relate to both components of a stock's yield. The first is called the expected dividend yield, and it has the following formula. The expected dividend yield is the dividend in year 1 divided by the price in year 0. So again, the dividend payment occurs one period after the time period that price is calculated in. And this is kind of akin to the present value of the perpetuity formula. We just have to make sure that those two numbers are separated by one time period. The next measure is called the expected capital gains yield. The equation for this is the expected price in year 1, that's P hat 1, minus the price in year 0, P0, all of that divided by price in year 0. And again, P1 hat is the expected price of the stock in period 1. And this yield, the expected capital gains yield, actually exactly equals the growth rate G, just by construction. That's basically what it's telling us. So the sum of these yields equals the investor's return on equity. Now this is kind of confusing. We call both the return on equity the previous thing that we just defined as the net income over the total equity, and the return on equity can also be the discount rate used to discount future cash flows when we're talking about stock valuation. So make sure you don't get these two confused. Usually when we say return on equity or rate of return on equity, we're talking about the discount rate, this small r sub s. So it shouldn't be a point of confusion, but just make sure you know that those two things are different. But back to this point, since we've defined these two yields in this way, the rate of return on equity is actually equal to the sum of these two things. What you expect to get in dividends over the next year, plus any appreciation of your stock price, which takes account for the growth. And so we can just write the return on equity in this way, the expected dividend yield plus the expected capital gains yield. And note, since the expected dividend yield, by definition, is the dividend in period 1 divided by the price in period 0, and the expected capital gains yield is the growth rate, we can also write the rate of return on stock this way. It's just D1, the dividend in year 1, divided by the price in year 0 plus the growth rate. So if we have the dividend, the price, and the growth rate, we can directly find the rate of return on equity just using this formula. So let's use the same numbers from the previous constant growth example and calculate the expected dividend yield and the expected capital gains yield. The expected dividend yield is the dividend in year 1, which was $2, divided by the price in year 0, which was $25. And again, we're using the numbers from when we added the growth of 2%. and so we found that the price was 25 bucks. And so we see that the expected dividend yield is 8%. To find the expected capital gains yield, we first need to find the price of the stock in period 1, because remember that equation, it was the expected price in year 1, P1 hat, minus P0 over P0. So for this, to find the price in year 1, we actually need the dividend in year 2, because remember, anytime we use that perpetuity equation, we need the dividend 1 year from where we want to find the value of the price. The dividend in period 1 is 2 bucks, and we know it grows at 2%. So the dividend in period 2 is just this $2 and compounded 1 period at 2%, so it's $2.04. So we know the price in period 1 is this dividend in year 2 divided by the rate of return on equity minus the growth rate. So it's the 204 over the 10% minus the 2%, so the price in year 1 is $25.50. Now we can find the expected capital gains yield. It's P1 hat minus P0 over P0. So 25.50 minus 25 over 25 gives us an expected capital gains yield of 2%. Notice that we do indeed get our return on equity of 10%, our original discount rate, when we add the dividend yield of 8% and the capital gains yield of 2%. That's the end of part 1.